Welcome back to the Deep Dive, the place where we take the core documents and crucial compliance concepts that shape your financial life and really break them down until they actually make sense.
We're here to give you that knowledge shortcut. Moving past just recognizing a form to a deep structural understanding, our focus is always on what this material means for you and, well, the broader economy.
Exactly. Today, we are plunging into a form that arrives in your mailbox every January. The Form W-2. If you earn a salary in the United States, you know exactly what it looks like. For most people, it's just that essential key they need to file their taxes.
Right.
But we're going far deeper. Few people truly appreciate its staggering role in compliance, its surprising history, or, and this is so critical, its potential as arguably the single most targeted piece of personal data in modern cybercrime.
Our mission today is to move you past just using the W-2 to fill out your 1040. We need to look at it through the lens of the IRS and the Social Security Administration. We'll cover the stringent compliance requirements for employers, detail why the deadlines are so inflexible, and explain why this document, which aggregates your income and tax payments, is really the foundational building block of the entire U.S. income reporting system.
So let's establish the core identity of the document right now. Officially, it is the Wage and Tax Statement.
That's right. It reports wages, salary, bonuses, any other compensation paid to an employee. And crucially, it tracks all the federal, state, and local taxes withheld from that pay.
And it also serves an absolutely essential second function, doesn't it?
It does. Reporting FICA taxes, that's Social Security and Medicare, directly to the Social Security Administration, or SSA.
That dual function is fundamental.
It is. It reports income tax payments to the IRS and your retirement and healthcare contributions to the SSA. And that automatically creates the key legal distinction we see in the workforce today.
The famous distinction, W-2 versus 1099.
Precisely. If you are a W-2 employee, it means your relationship with your employer is based on control. The employer directs the work, provides the tools, and, most importantly for compliance, handles the withholding.
So they're taking care of all the tricky stuff.
They are responsible for calculating and submitting your income tax withholding and half of your FICA contributions.
And that contrasts so sharply with the 1099 worker, the independent contractor.
Absolutely. The independent contractor, who gets a Form 1099, is responsible for managing their entire tax burden themselves.
The whole thing.
The whole thing, including paying both halves of the FICA tax, what people call the self-employment tax. The W-2, therefore, signals not just income, but a legal, structured employment relationship that shifts a huge amount of tax liability and administrative burden onto the employer.
Okay, let's unpack the W-2's role from the employee's side. This is the foundation for filing your individual tax return, but let's talk mechanics in detail. How is the W-2, structurally engineered to be the bedrock for Form 1040?
Well, it's the numerical source of truth. The W-2 dictates 4 critical figures you must transfer to your Form 1040.
4 key figures.
Yes. Box 1 is your total taxable wages. Box 2 is your federal income tax withheld. Then you have Box 3 and 5, which detail your Social Security wages and Medicare wages, respectively.
And the whole tax prep process basically starts right there.
It does. It starts with transcribing these figures. If you skip that step or mistype a number, the return is likely doomed before it's even fully processed.
I think for the vast majority of our listeners, the most scrutinized number on that form is Box 2, Federal Income Tax Withheld.
Oh, for sure.
This is the number that ultimately dictates if they get a refund or owe money.
That's where it really matters for most people. Throughout the year, your employer estimates your tax liability based on the Form W-4 you submitted.
Right, the form you fill out when you start a job.
Exactly. And they withhold that money from your paycheck. The total of all those estimated payments is captured right there in Box 2, the W-2.
So when you file your 1040, you're calculating your actual tax liability for the year.
Your actual final liability. And that final debt is then reduced by the amount in Box 2.
So a refund is simply the reconciliation.
It is the formal governmental reconciliation. If the sum of your estimated payments, what's in Box 2, is greater than the actual tax debt calculated on the 1040, you are entitled to the difference back.
That's your refund.
That's your refund. If the amount withheld was less than your final liability, you owe the difference. The W-2 is the official receipt for all those estimated payments you made throughout the year.
But here is the genuine aha moment that I think a lot of people miss, because it flips the form's function from just a personal receipt to the government's surveillance tool.
Right.
This is the mechanism of IRS cross-checking. We know the IRS receives a copy of the W-2 directly from the employer, but how does that compliance check actually work within the bureaucracy?
This is the critical engine of the U.S. tax system. It operates under what's called Information Return Processing, or IRP. Your employer submits copy A of the W-2, along with a summary form called the W-3, to the Social Security Administration. The SSA then shares that data with the IRS.
So the data gets there before you even file.
Exactly. When you, the employee, submit your Form 1040, you report your wages from Box 1 and your withholding from Box 2. The IRS computer system then matches the data provided by the employer against the data you provided.
And the implication of a mismatch is swift, isn't it?
It is entirely automated.
Yeah.
If the wages or withholding amounts you report don't match the electronic data from your employer, the system immediately flags the discrepancy.
So they don't even need to audit you in the traditional sense.
No, they know the number is wrong based on third-party verification. It's already been proven.
And what does that look like in practice for the taxpayer? What do you get in the mail?
Usually the taxpayer receives a notice, the infamous CP2000 notice.
Oh.
This notice details the proposed deficiency. It explains that the income you reported doesn't match the income reported by the third party, which is your employer via the W-2. It demands that you either justify the difference or pay the additional tax, plus potential interest and penalties.
So there's no hiding.
There is no hiding. This is why the W-2 is the central tracking mechanism. It removes the element of trust and replaces it with mandatory, independently verified data.
So the W-2 is the government's single strongest piece of evidence about your income. But you mentioned its usefulness extends far beyond the IRS. It's become the gold standard for formal proof of income for other major applications.
That's absolutely correct. Because the W-2 is certified by a third party, your employer, and cross-referenced with federal agencies, it carries immense weight.
Like for Social Security benefits.
The Social Security Administration relies heavily on it to verify your earnings for future benefits calculation. Courts use it extensively in, say, divorce, alimony, and child support proceedings to establish accurate income streams.
And what about for younger listeners?
Well, perhaps most relevant to them, the free application for federal student aid, FSS, uses W-2 data to determine financial need for college funding.
Even for personal finance, right? If you apply for a major mortgage, for example, you often need to provide the last 2 years of W-2s.
Yes, exactly. Lenders use it to verify stable, consistent employment and income. Unlike a simple pay stub, which can be pretty easily fabricated or manipulated, the W-2 is a federal document with a paper trail. It makes it the most reliable proof an individual can offer for their legitimate earnings.
Before we move on, let's tackle a specific technical nuance. Employees are required to report wage, salary, and tip income even if they don't receive a W-2 for that income. How does an employee handle that when the IRS is relying on employer-submitted forms?
That's a great question, because the burden of reporting income always falls on the taxpayer.
Always.
Always. If, for instance, an employer goes bankrupt and never issues W-2s, the employee still must calculate and report that income based on their final pay stubs.
How do they do that?
They would typically file Form 4852, which is a substitute for the W-2, explaining why the official form is missing. The IRS understands that employers sometimes fail their obligations, but that doesn't excuse the employee from theirs.
And this leads us to the specificity of tip income, which is a common source of confusion. How is tip income handled in the W-2 world?
Tip income is subject to the same income withholding rules as regular wages, and that is often misunderstood. Employees must report their tip income to their employers, usually monthly.
Using a specific form?
Yes, often using Form 4070. And the reason why is because the employer is then required to withhold income tax and FICA taxes on those reported tips to the extent possible from the employee's regular wages.
So wait, the employer is mandated to collect the tax on the tips even if they never physically handle the cash?
Exactly. And those tips, both cash and non-cash, must be accurately reflected on the final W-2. If an employee fails to report sufficient tips to the employer, they could face a penalty equivalent to 50% of the FICA tax owed on the unreported tips, in addition to the tax itself. It just solidifies the W-2's role. It's the universal document that tries to capture all taxable compensation flowing to the employee.
We've established the W-2 as the employee's critical receipt and the IRS's primary compliance tool. But let's pivot and consider the employer. For them, issuing the W-2 isn't just an accounting task, it's a massive logistical choreography that comes with strict deadlines and complex rules. It's basically a high-wire compliance act.
The administrative load is enormous, particularly for small businesses that don't have large payroll departments. And the deadlines are set not just to prompt the employer, but to give the employee maximum possible preparation time.
Let's nail down those crucial deadlines for the employer.
The primary deadline, burned into the memory of every payroll professional, is January 31 of the year following the tax year. The W-2 must be completed, printed, and in the mail to all employees by this date.
No exceptions.
Failure to meet this creates immediate liability for penalties.
And that January 31st date also applies to the governmental submission, right?
It does, and this is an important regulatory acceleration. Historically, employers had until the end of February to submit their W-2 copy A to the Social Security Administration.
But not anymore.
Not anymore. In recent years, the deadline for filing electronic or paper W-2s to the SSA was moved up to match the employee deadline, January 31.
And why the change?
This change was driven entirely by the IRS's need to cross-check income data earlier in the tax season to catch identity theft and fraud faster.
Ah, that makes sense. That explains why the filing process feels so compressed now. If the SSA gets the data earlier, the IRS can spot fraudulent returns filed in February much more quickly.
Precisely. Now, if despite this rush, an employer finds that they made an error, say they miscalculated a benefits deduction, they have to file Form W-2C, which is the official corrected wage and tax statement.
So another layer of complexity.
Another layer of compliance complexity, yes.
And before we get into the infamous 6 copies, touch briefly on how U.S. territories are handled.
The W-2 system accounts for every corner of U.S. jurisdiction. The 4 includes a mandatory box for a 2-letter territory code, for example, W-2GU for Guam, W-2PR for Puerto Rico. This ensures that the appropriate local taxing authority gets their copies and data, even though the core federal tax rules like FICA generally apply across all U.S. territories.
Now, for the logistical nightmare, the infamous 6 copies, when an employer prints out one W-2, they are physically printing 6 distinct copies with specific destinations. Can you detail the purpose of each copy and explain the mandatory accompaniment that ties the whole process together?
It truly is a 6-way paper trail designed for maximum redundancy and accountability. It's a lot.
Okay, let's start at the top with copy A.
We start with copy A. This is the absolute master copy. It is submitted by the employer directly to the Social Security Administration. The SSA uses this to record your FICA wages, that's boxes 3 and 5, and ensure your lifetime earnings record is accurate for future Social Security and Medicare benefits.
And I've heard copy A has some specific, almost anachronistic printing requirements.
That is a crucial technical detail, especially for paper filers. Copy A must be printed in a specific size, and critically, it must be the official red ink form ordered from the IRS or the SSA.
Red ink. Why?
Because the SSA uses high-speed optical scanning technology on their mainframes, and the official red ink is recognized and processed differently than standard black printouts. A copy A printed from a standard PDF is invalid.
Wow. That requirement really emphasizes the unique governmental security role of this particular piece of paper.
It does. And copy A never travels alone. It has a mandatory sidekick.
Which is?
Form W-3. Employers must submit this. It's a summary and transmittal form along with all their copy A submissions. The W-3 acts as a control document, aggregating the totals from every single W-2 they issued.
So it's a summary sheet.
It's a summary sheet signed by the employer, validating that the figures on all the W-2's total wages, total withholding, match the W-3's grand totals. It provides the IRS and SSA with a vital reconciliation point for the entire business payroll.
Okay, let's move to the employee's documents. You, the employee, receive 4 copies in total, B, C, and 2 state-local copies. Let's look at the federal copies first.
Copy B is for the employee, and this is the copy that must be filed with your federal income tax return, Form 1040, if you are filing a paper return. It serves as your physical proof that the withholding amounts you claimed are legitimate.
And the government uses that copy B to match their electronic copy A.
That's the system. Then we have copy C. This copy is also sent to you, the employee, but its purpose is strictly for your personal records. The IRS recommends keeping this document for at least 3 to 7 years, but given its importance for proving FICA contributions, many people, myself included, retain it indefinitely.
So B is for filing, C is for keeping. Now the state and local requirements.
This is where things get jurisdictional. Copy 1 is often retained by the employer and filed with the employer's state or local income tax returns. It's for the employer's state compliance needs.
And
Copy 2 is provided to the employee and is the one they must file with their state or local income tax returns to claim state withholding credits.
And finally, copy D, the last one.
Copy D is the internal copy retained by the employer for their own records. It's their audit trail. stored in case of an IRS or SSA inquiry.
So just to recap, A to the SSA, B to the employee for the IRS, C for employer retention, D for employer retention, 1 for the state employer, and 2 for the state employee.
It's redundancy at a massive scale.
That truly emphasizes how much effort goes into ensuring every dollar is tracked. Regarding the actual filing, what are the current rules on paper versus electronic submission, particularly that 250 form limit?
The IRS and SSA mandate digital compliance for efficiency. If an employer is filing over 250 instances of Form W-2 for the year, electronic filing is required. This threshold ensures that the largest filers who generate the most data provide that data in a machine-readable format.
But if they're under that limit, say they have 50 employees, they can still file on paper. And that's where that rule about the official copy A comes back into play, isn't it?
Yes. If a smaller business chooses to file by paper, they must use the official pre-printed Reading Copy A ordered directly from the SSA. They cannot just print it from a PDF downloaded from the IRS website.
And why is that so strict?
This specific high-security requirement for the papermaster copy underscores the regulatory seriousness. It prevents amateur businesses from using easily replicable templates, which could disrupt the SSA's processing flow, or worse, introduce fraudulent paper forms into the system.
If compliance is this strict, we have to look at what happens when it goes wrong. Let's transition now to the high cost of mistakes and delays. The government has imposed some extremely high penalties, and the tiered nature of those penalties really highlights the W-2's critical role in their system.
The penalty structure is explicitly designed to incentivize speed and accuracy. It's a very costly lesson for employers who drag their feet. We see a clear escalation based on how late the forms are filed and how large the business is.
Let's break down the late filing penalty tiers. What does it cost a business that just misses that January 31st due date?
If the employer is late, but manages to file within 30 days of the due date, so before the end of February, the penalty is $30 per form. Now, this isn't necessarily capped based on business size at this level, but the caps start kicking in very quickly.
And what if they push it past that 30-day mark but still get it in before August 1st?
The penalty doubles. It increases to $60 per form, and this is where the caps are introduced. For small businesses, which are defined roughly as those with average annual gross receipts of $5 million or less, the maximum annual penalty in this tier is capped at around $200,000.
$200,000. And for larger businesses?
For larger businesses, the cap rises to about $500,000.
Wait, $500,000 for a large corporation that is late but still files before August 1st? That's already a substantial incentive.
Yeah.
But if they wait past August 1st, the cost becomes punitive.
After August 1st, the penalty spikes again, increasing to $100 per form.
Wow.
And the corresponding annual caps for this severe level of delinquency also escalate, up to around $500,000 for small businesses and $1.5 million for larger enterprises.
$1.5 million.
The message is simple. The IRS values timely information above all else, and your failure to provide it on time actively compromises their ability to conduct fraud cross-checking and tax administration.
Is there any provision for a reasonable cause when calculating these penalties, or is the IRS completely inflexible on that January 31st date?
That's an important question. The IRS does provide limited avenues for seeking abatement, claiming reasonable cause. For instance, if the business suffered a casualty, a fire, or an unavoidable absence of the person responsible for filing.
But not just because you forgot.
No, simply forgetting, misunderstanding the law, or claiming lack of funds is generally not accepted. The system is designed for strict liability, meaning if you miss the deadline, the penalty calculation begins, and the burden of proving reasonable cause is extremely high.
Now let's pivot from lateness to inaccuracy. What happens if the employer files the W-2 on time, but the wages, the name, or the withholding amounts are just wrong?
This is another major area of financial risk for companies, and the penalty for incorrect forms is particularly harsh because an incorrect form causes problems for both the employee and the government. For a single incorrect form W-2, the penalty is $250 per receiving party.
Let me make sure I understand that multiplier. If a business sends one incorrect W-2 to the employee, that's copy B, and one incorrect copy A to the S-heirs, that single mistake costs the business $500.
That's exactly right. $500 for a single error. Now, consider a mid-sized employer with, say, 1,000 employees. If they make a systematic error in their payroll software that affects a retirement contribution for every employee, that company is suddenly facing $500,000 in penalties.
Right out of the gate.
Right out of the gate.
And what is the maximum exposure for a massive corporation that makes a widespread systematic error?
There is an annual cap on the incorrect form's penalty, but it is high, currently set at $3 million.
$3 million.
For the largest corporations, this acts as a hard ceiling, but it remains a terrifying prospect for everyone else. It is also crucial to note that this specific penalty amount was significantly increased back in 2015.
Why the increase in 2015? Was that just a revenue generation move, or did it reflect a deeper regulatory need?
It was a direct response to the increasing sophistication of tax fraud and the rising reliance on automated cross-checking. As the IRS shifted more of its compliance work to digital systems, the integrity of the source data, the W-2, became paramount.
So a bad W-2 gums up the whole works.
A bad W-2 creates delays, causes those CP2000 notices to be issued incorrectly, and forces expensive manual intervention. The 2015 increase signaled the government's rising intolerance for reporting errors that compromise their entire automated system.
Are there penalties for non-compliant filing methods as well, things that seem smaller?
Absolutely. There are penalties for issues that might seem minor but disrupt the processing flow, like submitting illegible forms or failing to include the employer's taxpayer identification number. And critically, there are penalties for filing by paper when that 250 form threshold required electronic filing.
So any violation of procedure can cost you.
Essentially, if you violate any of the procedural requirements that facilitate quick governmental data processing, you pay.
And the final category, intentionally failing to file.
That is the most egregious category, reserved for deliberate, willful noncompliance or outright fraud. The penalty for intentionally failing to file is $500 per form with no cap, and this can also lead to criminal charges.
So it gets very serious very fast.
The mere existence of these tiered, escalating, and uncapped penalties demonstrates that the W-2 is not optional. It is a mandatory governmental regulatory requirement backed by serious financial and legal consequences.
To truly appreciate the vast regulatory weight the W-2 carries today, we need to understand its historical context. Let's delve into the origins of this system, because the birth of the W-2 is tied directly to a massive foundational shift in how the U.S. government finances itself.
It is a classic piece of wartime bureaucracy that became a permanent fixture. The use of the formal W-2 system was established by the Current Tax Payment Act of 1943.
The 1943 Act, which was revolutionary because it fundamentally altered the relationship between the government and the taxpayer. It initiated the withholding of income right at the source, directly from the paycheck.
Right. Before the 1943 Act, most Americans had to calculate and pay their entire annual tax bill in one or two large installments. For the average worker, suddenly owing a massive lump sum in March or April was a huge financial strain.
Especially during World War II, when the tax base was broadening to finance the war effort.
Exactly.
So withholding was essentially a budgeting and compliance solution.
Precisely. Instituting continuous withholding made tax collection automatic, kind of painless since you never see the money, and consistent. It provided a steady, predictable cash flow for the government, and it eliminated that annual shock factor for the taxpayer.
And the W-2 was created specifically to serve as the document verifying this new system.
It was the proof. Proof that the employer withheld the money and paid it over to the government.
And the first official documents were issued almost immediately.
The very first W-2s were issued to employees in 1944, documenting that inaugural year of mandatory income withholding. It marked the moment the employer became an unpaid tax collector for the government.
The form itself has undergone an evolution, both in name and appearance. When did the title change?
In 1965, the form's original title, Withholding Tax Statement, was officially updated to its current name, the Wage and Tax Statement.
Why the change?
This title reflected the form's dual purpose. It reports the total wages in Box 1 and the tax withheld in Box 2, recognizing its broader function as a comprehensive earnings report, not just a tax receipt.
And when did the form take on that familiar, standardized, numbered box layout we rely on for software filing today?
That standardization is a significant marker of technological adaptation. The form's appearance changed to its modern style of distinct numbered boxes in 1978.
And that was a necessary step for computers.
It was. It was to facilitate the growing use of computer processing and standardization in tax preparation. That numbered box structure makes data transcription and optical scanning far more efficient than the older, less organized layouts.
And that standardization was critical because the tax code, and therefore the W-2, has only become exponentially more complicated since 1978.
Absolutely. The complexity of the W-2 serves as a real-time historical ledger of legislative changes. Every new tax incentive, every new federally tracked benefit, every piece of complex deferred compensation has to be recorded on there somewhere.
Can you give an example of how one specific set of boxes illustrates that legislative complexity?
Look at box 12. It's perhaps the most confusing for the average employee. This box tracks specific types of compensation or deductions using single or double-letter codes. It's a microcosm of the evolving tax code.
For instance,
For example, Code D tracks elective deferrals to a 401k. Code DD, which was added more recently, tracks the cost of employer-sponsored health coverage. It's not taxable income, but the government wants to monitor the value of that benefit.
so the addition of Code DD is a perfect example of the W-2 evolving past simple tax collection and into the tracking of social and economic policy.
It is. The W-2 became the most reliable way for the government to gather information about health benefits and compensation outside of direct wages. The form's physical expansion and the multiplication of these codes directly track the increasing sophistication of benefits packages and the government's regulatory appetite for data.
And as we noted earlier, the increasing complexity of the data has gone hand in hand with rising enforcement, highlighted by that 2015 penalty increase. It's a vicious cycle of complexity and consequence.
It is. The W-2 is no longer just a simple receipt from 1944. It's a complex, multifunctional data document that has absorbed nearly 80 years of federal policy, and its accuracy is now non-negotiable for millions of automated compliance checks.
Now we arrive at a section that directly impacts every individual listener, the dark side of the W-2. Because this form is such a concise repository of high-value personal information, it has become a prime target for sophisticated cybercrime, specifically phishing and identity theft.
This is where we shift from compliance risk to personal risk. Why is the W-2 so highly prized by criminals? Well, it contains the employee's full legal name, home address, total income, and, critically, the Social Security number.
The Holy Grail.
With that data, a criminal can easily file a fraudulent tax return and claim the refund, often before the actual employee has even begun their own filing process.
It's the ultimate target. All the necessary pieces for tax-related identity theft wrapped up in one single document.
And this threat became so acute that the IRS issued a major, specific alert in March 2016, aimed directly at businesses. They noticed a distinct, repeatable pattern of attack.
Let's discuss the specific methodology the criminals employed, focusing on spear phishing and email spoofing.
This wasn't generalized spam. Spear phishing means the attack was meticulously targeted at specific employees within companies, payroll managers, HR staff, accounting specialists, the people who actually had access to the W-2 database.
So they weren't wasting their time on general staff.
No. And the email spoofing layer was critical for social engineering.
How so?
The emails were sent using spoofed accounts, making them appear as if they were coming from a high-ranking company executive, usually the CEO or CFO. This created an immediate artificial sense of urgency and authority, designed to make the recipient bypass standard security protocols and comply immediately.
Right. If the CEO is asking for employee tax data ASAP, the pressure on the payroll clerk is immense. The source provides the exact quotes used in these phishing attempts, and they are unnerving in their specificity.
There are textbook examples of efficient social engineering. One example that sought comprehensive data was, can you send me the updated list of employees with full details? Name, social security number, date of birth, home address, salary.
They were asking for the entirety of the HR master file.
Based on the W-2 structure, yes.
Another request was even more direct about the form itself.
Yes, targeting the previous year's records. Kindly send me the individual 2015 W-2 PDF and earnings summary of all W-2 of our company staff for a quick review. The request for a PDF attachment is key. It's easily downloadable and transferable.
And a third example that relied entirely on urgency.
I want you to send me the list of W-2 copies of employees' wage and tax statements for 2015. I need them in PDF file type. You can send it as an attachment. Kindly prepare the lists and email them to me ASAP. The repetition of ASAP is a classic psychological manipulation to prevent the employee from pausing to verify the sender's identity via, say, a separate phone call.
And the ultimate goal, once they secured this bulk W-2 data, was identity theft. But not just any identity theft, tax-related identity theft.
Correct. The criminals used the Social Security numbers, coupled with the verified income and withholding figures provided by the W-2, to construct a completely legitimate-looking Form 1040. They file it electronically early in the filing window, claim the maximum possible refund, and have that refund direct deposited into a burner account.
All before the actual taxpayer has even filed their return.
All before. The IRS explicitly defines this crime as tax-related identity theft.
And this wasn't just a threat. The source documents large, recognizable, and highly sophisticated companies that fell victim to this W-2 scheme in early 2016.
We saw high-profile breaches at companies including Snap Inc., Mansueto Ventures, and Seagate.
Big names.
Big names. And this serves as a stark warning. If organizations with sophisticated cybersecurity teams can fall victim, it means the human element in payroll is the critical weakness. Security systems are often designed to stop malware, but not a cleverly worded email from the CEO.
What classification did the cybersecurity community and law enforcement give to this specific scheme?
The cybersecurity industry categorized this as a type of CEO fraud because it exploits the hierarchical authority within an organization. Meanwhile, the FBI's Criminal, Cyber, and International Operations divisions classified it as a type of business email compromise, or BEC.
And it remains a huge problem.
It remains one of the most financially damaging forms of cybercrime today, purely because the W-2 is such a perfect, consolidated data package.
That underscores a sobering reality. The W-2, designed to be the ultimate document of compliance, has become the ultimate target for criminals seeking financial gain from that very compliance system.
Now let's zoom out and look at the W-2 in a global context. The U.S. system, complex as it is, reflects a universal necessity. Every modern formalized economy needs a way to track wage withholding and ensure tax compliance between the three parties: the worker, the employer, and the government.
That connects the complexity of the W-2 to the bigger picture. It shows that the U.S. regulatory architecture isn't totally unique. It's simply our specific iteration of a global standard.
What's fascinating here is that every international equivalent performs the same core function reconciling tax paid versus tax owed, but they often integrate broader social programs that the U.S. W-2 does not.
Let's look at some of those international equivalents mentioned in the source material, starting with our neighbors to the north, Canada.
In Canada, the equivalent form is the T4. Like the W-2, it reports wages and income tax deducted. However, the T4 also reports contributions to the Canada Pension Plan, or CPP, and Employment Insurance, EI.
Moving across the Atlantic to the UK, they have a form that looks very different but serves the same purpose.
In the UK, you have the P60. This form is given to employees after the tax year ends and summarizes all taxable income and all tax deducted under their pay-as-you-earn system, or PAYE.
Now, what else is on there?
Crucially, the P60 also summarizes national insurance contributions, NICs, which fund state pensions, and the National Health Service, the NHS.
That's a key functional difference right there. The US W-2 separates income tax for the IRS and FICA for the SSA, but the P60 in the UK consolidates taxes, pensions, and universal healthcare funding all in one place.
Exactly. The W-2 is relatively limited in its focus on FICA and income tax, while many international analogs integrate data points related to pensions, statutory sick pay, and national health systems.
Moving east, we see similar consolidation.
Poland uses the PIT-11, which reports income, tax withheld, and social insurance premiums. Russia uses the 2NDFL for confirming income and withheld taxes. The function is consistent: mandatory, documented third-party reporting.
And the Middle East and Asia are also represented in this global system.
Correct. Israel uses the 106 form, which is crucial for proving employment and income. India relies on Form 16, mandatory for employees whose tax has been deducted at the source. And in the Philippines, you have the BIR Form 2316, which summarizes income and tax withheld.
Finally, in Africa.
South Africa uses the IRP5IT3A. Again, these forms are essential for managing their payee system and ensuring that the South African Revenue Service can cross-reference what the employee declares against what the employer reports.
It demonstrates that the W-2, in all its complexity, is simply the American mechanism for navigating the global reality of government oversight and compliance. Every industrialized country has mandated employer bookkeeping duties that mirror the massive logistical headache we detailed earlier. We've truly taken an exhaustive deep dive into the wage and tax statement Form W-2. Let's review the critical knowledge takeaways that we hope stick with you.
Firstly, remember the W-2 is far more than a simple summary of your earnings. It is a powerful, verified piece of evidence that is the cornerstone of the entire U.S. tax compliance system.
And its value is really quantified by those steep escalating penalties.
Absolutely. The penalties imposed on employers for late or inaccurate filing are a clear governmental signal that the form's integrity is non-negotiable.
Secondly, its complex architecture, the 6 copies, the required W-3 summary, and that strict January 31st deadline reveals its foundational role. It is the primary, mandated third-party verification tool the IRS uses to cross-check what you report against what your employer reports.
Right. It ensures compliance through automated checks like that CP2000 notice.
And finally, because it concentrates all of your core personal and financial data, specifically your SSN, address, and verified income, it makes you, or really your company's payroll department, a prime target for high-level cybercrime.
The W-2 is the single document most coveted by perpetrators of CEO fraud and business email compromise seeking tax-related identity theft. Vigilance in securing this data is absolutely paramount.
It is genuinely fascinating how such an ostensibly dry administrative document dictates so much compliance, financial structure, and personal risk. But let's leave you with one final provocative thought to mull over as you prepare for the next tax season.
We've established that for large businesses, the W-2 data, that's copy A, is required to be submitted to the SSA electronically by January 31st. This means the IRS and SSA already have your full, structured, validated income and withholding figures months before April 15th.
So, if the government already possesses the data electronically and has for months, why does the requirement persist for the employee to attach the physical paper, copy B and copy 2, to their individual tax returns when they file by mail?
Is that paper requirement simply a legacy obligation, a bureaucratic habit reflecting outdated filing processes from the pre-digital era?
Or something else?
Or is the government deliberately maintaining that physical paper attachment to Form 1040 as a final mandatory security step? A requirement for the employee's physical signature and confirmation that the paper record they hold matches the electronic record the employer submitted, ensuring a final human reconciliation of the data.
Something to think about next time you're filing your taxes and debating whether to shred or keep those multiple copies. That's all the time we have for this deep dive into the W-2. Thanks for tuning in.
Stay informed and stay compliant.